Okay, I think that we are ready to get started, and thank you again for joining us today to talk about everybody's favorite subject, student loans. And today we are going to be focusing on Parent Plus borrowers and also married borrowers who might need some tips, considering that it is tax season. So my name is Nancy Neerman. I am the Assistant Director of the Education Debt Consumer Assistance Program, or EDCAP. I'm joined here by my colleague, Carolina Rodriguez, who is the director of the program. Just some housekeeping items before we start. I'm going to be doing the presentation, but if you have any questions that you want to ask during the presentation about anything that I'm speaking about or any other issues pertaining to student loans, feel free to type them into the Q&A box. We don't, the chat should be, you'll be able to read the chat, but you won't be able to post anything in the chat. So use the Q&A box for your questions. Carolina is going to be answering questions behind the scenes as we go along. And we will pause periodically to address some of those questions publicly. We will provide a recording and a copy of the presentation materials after the webinar is over to everybody who's registered and attended. So with that, I'm going to just take myself off video and share the screen, and we will get started. Okay. And Carolina, if you could just confirm that you can see the screen.
Yes, we can see it. Thank you.
Great. Okay. So we're going to be talking about a couple of specific topics today pertaining to student loans, but we'll give you a little bit of smattering of some of the bigger things that have been announced over the last several months, like the changes to borrowing limits and repayment plans. But we're going to be focusing on Parent Plus borrowers and married borrowers. To start off, I just want to tell you a little bit about our program at CAP. We are a program of the Community Service Society, or CSS. CSS is a nonprofit that's been very active in New York City for over 180 years. The EDCAP program was established in 2019 specifically to tackle the issue of student debt. So student debt is the second largest consumer debt in the country, next to mortgages. Nationally, it's a $1.7 trillion issue. In New York State alone, there are about 2.5 million borrowers who hold close to $100 billion in debt. Um, our program is funded by New York State, which allows us to offer things like these webinars for free. And we also offer one-on-one counseling. So as we go through this presentation, and if you feel that you have a situation that's a little bit more complicated that you can deal with on your own, feel free to reach out to us at the end of this presentation. We'll have contact information. You can set up a one-on-one counseling session. Those are also free, and they're not limited to just one. If you need more than one to resolve your issues, that would be fine as well. All right, so let's get right into it. We want to talk about Parent Plus loans, and you'll see the reason why we're bringing this up right now, because there are some critical decisions that have to be made, and potentially some action that may need to be taken by Parent Plus borrowers in the next few months. So just as an overview, the One Big Beautiful Bill Act, that was the big budget bill that was signed into law last July, is going to make some very sweeping changes to the student loan system. And Parent Plus borrowers are amongst those that are going to be most significantly impacted. So future Parent Plus borrowers are going to have no access to repayment plans that are based on income. Remember, those are called income-driven repayment plans, or IDR plans. And those Parent Plus borrowers in the future will also not have access to a couple of big forgiveness programs that borrowers in the past have relied on. And that would be income-driven repayment forgiveness, or IDRF, which forgives debt after making 240 to 360 qualifying monthly payments. That's 20 to 30 years of qualifying payments in one of the IDR plans. Now, there's no employment requirements for this particular program. And then, of course, a lot of you have heard about and may be involved in public service loan forgiveness, or PSLF. PSLF forgives debt after making 120 qualifying months of payments. So that's 10 years of qualifying payments while working an average of 30 hours per week for one or more qualifying employers. And a qualifying employer would be generally defined as a nonprofit or a government. So there obviously is an employment requirement for PSLF, but if you meet those employment requirements, it gets you to forgiveness faster. Now, Parent Plus borrowers who do not plan to take out any additional debt on or after July 1st of 2026 can retain access to income-driven repayment plans. So that's plans that are based on your income and to these forgiveness programs, but you may need to take action. So that's what we're going to go over right now. Who needs to take action and when you may need to do that and what you may need to do. So just to set the stage for all of this, I just want to kind of review the changes to the borrowing limits that are going into effect starting July 1st of 2026. So for undergraduate borrowing, and that would be borrowing things like direct subsidized and unsubsidized loans, there is actually no change to that. So right now, a student can borrow for themselves anywhere from if they're a dependent student, they can borrow from $5,500 per year up to $7,500 per year with no more than $31,000 overall for their undergraduate studies. If they're an independent student where you have to meet certain requirements, you can borrow between $9,500 and $12,500 per year, up to $57,500 in total. So there's no changes to that. Where the changes start are with the graduate school loans. So for direct unsubsidized loans for graduate school, if you're pursuing a master's degree, just a regular master's degree, the annual limit is $20,500. So that actually hasn't changed. And the lifetime limit for a master's degree is now $100,000. If you're pursuing a professional degree, and a professional degree is generally going to be defined as a law degree or different types of medical degrees. That makes up the lion's share of what is considered to be a professional degree under these new rules. You can borrow up to $50,000 annually or a lifetime limit of $200,000. Now, what's absent from the professional degree definition are things like nursing, education, um, social work. Those will all be limited now to $100,000 over a lifetime. And why this becomes particularly important is because of this next bullet, which is the Graduate Plus loans. So the Graduate Plus loan program is a program that allowed graduate students to borrow up to the cost of attendance, meaning they could borrow the cost of attendance minus whatever other aid they were getting for their graduate school degrees, and that includes direct unsubsidized loans, or other scholarships or grants. And that way they could fund their entire graduate school degree within the federal student loan system. This program is being phased out starting July 1st of 2026. So in the future, bars are going to be limited to either $100,000 or $200,000 lifetime to get their graduate school degrees within the federal system. And if you're pursuing an expensive degree, that might mean that you're going to have to look to alternative sources, perhaps private loans, to fund whatever the gap is. Now, that leads us to Parent Plus loans, which is the topic of our conversation today. So Parent Plus loans functioned in a similar way to Graduate Plus loans. Now, they were only available to parents of dependent students who are pursuing undergraduate degrees. You cannot take a Parent Plus loan to help your child with a graduate degree. In the past, there was no limit to borrowing in terms of Parent Plus loans. You could borrow up to the cost of attendance. So that's cost of attendance minus whatever aid the student was getting. So that's a combination of their federal student loans and any grants or scholarships that they may have gotten. So that would allow between the student and the parent, you could borrow and keep all your and fund the entire undergraduate education within the federal student loan system. So with the Parent Plus loan program, they're not eliminating the program. However, they are placing limits on it. So there's going to now be an annual limit of $20,000 per child and a lifetime limit of $65,000 per child. And they're going to be looking at borrowing between both parents. So let's say on an annual basis, your child is going to a school that costs $50,000 a year. If they're only getting $10,000 worth of aid, The gap that you have to fund is $40,000. However, you will only be able to get $20,000 now from the federal government. Now, there is a grandfathering clause that applies to these plus loan borrowing limits. So if the student has a direct loan that's dispersed before July 1st of 2026, then graduate students and parents can borrow under the existing rules. So they can borrow up to the cost of attendance for a maximum of 3 years for that student to complete their program of study. But, and this is the big but, the important thing to know is that even though you're able to borrow under the current rules, you must pay back the loans under the new rules, and that's going to have some very important consequences for parent borrowers going forward. Which brings us to the repayment plan options, past, present, and future. So again, just setting the stage so that we'll all be on the same page when we use these terms going forward. In the federal student loan system, there are generally two different ways to make your payments. There are traditional repayment plans where the payments are based on the loan balance, the interest rate, and a predetermined payback period that currently ranges from 10 to 30 years. Under the new rules, that payback period is going to range from 10 to 25 years. And these traditional plans do not offer forgiveness. So this is like paying back any kind of regular consumer debt. Particularly the fixed versions of these plans, you make the monthly payment over the life of the loan, after which you've paid off the entire balance, including all the interest. So it's like paying back a mortgage or an auto loan. The existing names of these plans would be things like standard. Again, that the repayment terms range anywhere from 20 to 30 years. Extended repayment plan, that's a 25-year fixed plan. And then you have graduated repayment plans that's where the payments start lower and then they increase over the life of the loan. And those, again, payback periods can range from 10 to 30 years. Under the new rules, there will only be one standard plan. It's called tiered standard plan. There's only going to be a fixed repayment version, and the payment term is going to be 10 to 25 years based on the size of the debt. The alternative to traditional repayment plans are income-driven repayment plans. And when I say income-driven or IDR, that's an umbrella term for some of these other individual plans that we're going to be discussing. In the IDR plans, the payments are based on income, family size, and tax filing status. So they really, in most cases, have nothing to do with the size of the debt. The plans have to be recertified annually. They offer forgiveness after, that should say 20 to 30 years of payments, not 10 to 30 years of payments. They do offer forgiveness after 20 or 30 years of payments. And they are all eligible for public service loan forgiveness, which is a 10-year path to forgiveness. The existing names of these plans are income-based repayment, or IBR, income contingent repayment, or ICR, pay-as-you-earn, or payee. ICR and payee are going to be phased out through this new budget bill by July 1st of 2028. And then we've got the SAVE plan, which we're going to talk about in a little bit more detail in a second. This plan has been facing a lot of legal challenges and is likely to be eliminated sometime this year. And then there is going to be a new plan that's going to be introduced starting July of 1st of this year, and it's called the Repayment Assistance Plan, or the RAP plan. So I just wanted to go over all of that because we're going to be using this terminology going forward so that everybody kind of understands what I'm talking about. So starting with the end of the SAVE plan for any of you that may be in this plan, and what that means for borrowers. As you well know, the SAVE plan was introduced by the Biden administration in 2023. It was going to be, by far, for most borrowers, the cheapest available repayment plan, which led over 8 million people to enroll in that plan. And then it started facing legal challenges. People have been in forbearance in that plan since July of last year because awaiting the outcome of a lawsuit. It was announced in the not too distant past that the Department of Education has reached a settlement proposal with the plaintiff in the case, who is the state of Missouri. If that proposal is approved, that will end the SAVE plan immediately once it's approved. Now, if that for some reason is not approved, the SAVE plan will be potentially in existence until July of 2028 when it's phased out by the new bill, but it may not be accessible to anybody the same way it's not accessible to anybody right now. So the court has to approve the proposal, which they have not done yet, but once they do, the Department of Education is going, or if you hear me say Ed during any of this, that's the Department of Education. Ed is going to notify borrowers what the timeline will be for exiting the save forbearance. It's estimated that there are over 7 million borrowers still in the save forbearance. We, at this point, do not expect the save plan to um, to live beyond the end of this year, but we don't know exactly when the court is going to approve it. The one thing that we're saying at this point is that borrowers should not necessarily rely on the forbearance lasting until 2028, late 2028, which is what a lot of servicer accounts indicate. If you were to log into your Mohila account or your Advantage account, you might see that the forbearance is going to be in place until November of 2028. That probably will not happen, but stranger things have happened. You have to stay tuned. Now, this does not mean that borrowers must get out of the save forbearance now. It is not officially ended. But just keep in mind that if you elect to stay in it, interest is continuing to accrue on your account, and no credit is being earned towards forgiveness at this time. So if you do not choose a new plan um, once the department ends the save plan, they're probably going to place you in the standard repayment plan. It could well be the standard 10-year fixed repayment plan, which for a lot of people is not going to be affordable. But if that happens, just keep in mind, don't panic, because you still will be able to file an application to switch to a different income-driven repayment plan. All right, so that's the save plan. Now we're going to get closer to the topic at hand here. So let's talk about repayment plans for the future. So if a borrower takes out a new loan or consolidates an existing loan on or after July 1st of 2026, you're going to have only one or two options for paying that loan back, or for paying all your loans back, actually. So you'll have the standard tiered fixed repayment plan, which is going to be available to student and Parent Plus borrowers. And then again, the payback period is going to range from 10 to 25 years based on the size of the debt, but there's no forgiveness options in that program. You just pay until you pay the debt off. And then there's going to be one new income-driven repayment plan. It's called the WRAP plan. This is only going to be available to student borrowers with direct loans. So Parent Plus borrowers are not going to have access to this plan. Um, the plan calculates payments at 1 to 10% of your adjusted gross income. That's for income above $10,000. Payment is reduced by $50 for each dependent that you claim on your tax return. So that's a less generous treatment of dependents than on the current income-driven repayment plans. And there is going to be a minimum $10 payment on the existing plans. If your income is very, very low or non-existent, you could be eligible for a $0 plan. If that's your circumstances on the WRAP plan, you would be required to pay at least $10 a month. Now, on the plus side, there are some good aspects of the WRAP plan. If your payment does not cover interest, then unpaid interest is not going to be added to your loan balance. So that means your loan balance will not increase, which, again, if you have a sort of large loan balance and a moderate to low income, generally the payments that you're making in an income-driven repayment plan don't cover the interest. And under the existing repayment plans, that unpaid balance gets added to your loan balance, and you see your total balances going up every month. And that's why people get so upset, because it's disconcerting when you're making payments to see your balances increase. That will not happen on the WRAP plan as long as you're making whatever the required payment is, even if it's only $10. In addition to that, if the payment that you're making does not lower your principal by at least $50 a month, the government will kick in and your principal will be reduced by up to $50 per month. So as long as you continue making the payments, you're going to get the interest and principal subsidy. And not only will the balances not go up, but they will actually go down by at least $50 per month. Spousal income, if you're married, can be excluded when filing taxes separately. And we'll be going to be talking about this in the second half of this presentation. That's a good thing and sometimes can help married borrowers keep their payment amounts down. On the flip side, the downside to this plan is that there's no protected income and there's no adjustment for inflation, so it may make the plan a little bit more expensive as years go on. It offers forgiveness, that long-term income-driven repayment forgiveness, but after 30 years. So under the existing plans, you can pay between 20 or 25 years and get your loans forgiven. Under RAP, you would have to pay for 30 years. But it is eligible for PSLF, and if you're pursuing PSLF, it doesn't matter what repayment plan you're in, or what eligible repayment plan you're in. If you're in an income-driven repayment plan, your path to forgiveness is 10 years. All right. So under the terms of the new rules, there's this thing called the same payment rule. The OBBBA states that all of your loans must be paid back in the same repayment plan. And this applies to loans for students and to Parent Plus borrowers. So what this means is that if you take out a new loan or consolidate an existing loan on or after July 1st of 2026, if you're a student borrower, then all of your loans, including the older ones, must be paid back in either the RAP plan or the new tiered standard plan. More importantly, what this means for Parent Plus borrowers is that all of your loans, including all of your existing loans, can only be paid back in the standard plan. So, like I was saying before, even if your loans are consolidated, you cannot enroll in the RAP plan as a Parent Plus borrower. So, what this essentially does is blocks any access to those two big forgiveness programs that we talked about, IDR forgiveness and public service loan forgiveness. Now, the one exception to this rule is that if you have both student loans for yourself and Parent Plus loans, you can pay the student loans in the RAP plan and you can pay the Parent Plus loans in the new standard plan. All right. Now, I said at the very beginning, if you are a Parent Plus borrower that does not plan to take out any additional debt on or after July 1st of 2026, that's student loan debt, Parent Plus loans, you are considered to be what's called a legacy borrower. And if you fit into that category, you can retain access to income-driven repayment options and to forgiveness programs, but there are steps that you may need to take in order to do that. So first and most importantly, you must have fully consolidated loans dispersed before July 1st of 2026. That doesn't mean that you can submit the application to consolidate on June 30th and you're good. No, you have to submit the application and the whole process must be completed. The new loan must be dispersed no later than June 30th of 2026. So basically, if you have unconsolidated Parent Plus loans, you're not planning to borrow anymore on or after July 1st of 2026, you need to get those loans consolidated, and we recommend submitting the application no later than March 31st. So that's in about another month. And March 31st, by the way, is not a hard, fast deadline. It's just that it takes about 4 to 6 weeks to process the consolidation applications. We want to allow enough time to make sure it's processed before June 30th. Once you're consolidated, you then must enroll in the income contingent repayment or ICR plan and make one payment in that plan. You must do this before the ICR plan is phased out in 2028. After that, you're going to have access to the income-based repayment plan, which in most cases is going to be cheaper than ICR. So just remember the key thing right now is consolidation. That's the key deadline that you have to meet. You don't have to worry about enrolling in ICR and making that one payment by July 1st, but you will have to do it at some point if you want access to the income-based repayment plan, which is the one existing plan that will continue to exist for legacy Parent Plus and legacy student borrowers, those that were not taking any new loans on or after July 1st of 2026. In terms of the IBR plan, the one that you will eventually be eligible for, there is no income test. So this used to be a thing in the past. If your income was high in comparison to your debt balance. You might have been excluded from being able to get into that plan. That income test no longer exists, but it does have a payment cap. So you would never have to pay more than what you would pay in the standard 10-year fixed repayment plan in the IBR plan. So that basically means that anybody with direct or FFEL loans can enroll in IBR with the exception of Parent Plus loans. And you can do it without the income test and still be eligible for the payment cap. Now, there's two different versions of IBR. The first version is called IBR for new borrowers. If your first loans were dispersed on or after July 1st of 2014, but before July 1st of 2026, then the payment is going to be calculated at 10% of discretionary income, and you'll have a 20-year path to forgiveness. If you have any loans that were dispersed prior to July 1st of 2014, you're only going to be eligible for the older version of the IBR plan, and that's calculated at 15% of discretionary income with a 25-year path to forgiveness. But just remember also, if you're pursuing PSLF and you're in any one of these income-driven repayment plans, the path to forgiveness is 10 years. Just remember also, if you take new or consolidate existing Parent Plus loans on or after July 1st of 2026, then all your Parent Plus loans, including all the older loans, have to be paid back in the new tiered standard plan. So you will essentially lose access to these other forgiveness programs. Now, if you are pursuing PSLF and you're a Parent Plus borrower, unconsolidated Parent Plus loans can be eligible for PSLF qualifying payment credit. And post-consolidation, you can get a weighted average credit towards public service loan forgiveness. In order to do that, before you consolidate, we generally tell people that you should update the qualifying payment count before consolidating if there is time. If you're going to do that, you want to use the PSLF help tool and request an electronic signature from the employer. But if you're bumping up against this consolidation deadline to ensure that you have access to IDR and forgiveness, you may not have time to go through this process. It doesn't mean that you won't get the qualifying payment credit after consolidation. It just means that you won't have it on record before you do the consolidation. But at the end of the day, making sure that you have continued access to IDR and forgiveness programs is probably going to be more important. And you can always reach out for help and guidance on that before you go through and do anything. So action steps for Parent Plus borrowers, and again, these are for legacy Parent Plus borrowers. You must consolidate your loans before July 1st of 2026. We're recommending submitting the application no later than March 31st. You eventually must enroll in the ICR plan and make one payment in that plan before it's phased out, which right now is slated for July 1st of 2028, after which you can switch to IBR, which for most people, IBR is going to be a cheaper option than ICR anyway, so that's not necessarily a bad thing. New loans taken or existing loans consolidated on or after July 1st of 2026, you will have no access to RAP or the modified IBR plan and no path to IDR or PSLF forgiveness. So the action steps: begin the consolidation and the IDR enrollment now if you haven't already done so. If you took out new loans for spring of 2026 and those are your last loans, consolidate those now. Those should be dispersed and ready to consolidate once they're dispersed, and as long as they're not in an in-school status. If you have defaulted Parent Plus loans, you probably want to reach out to us for some help here. You can consolidate your defaulted Parent Plus loans to get them to remove the default, and that will basically kill two birds with one stone. You'll get yourselves out of default, and if you do it in time, you'll meet that July 1st, 2026 deadline so that you will continue to have access to IDR plans and forgiveness programs once you come out of default. But consolidating defaulted loans is a little tricky right now, so you might want to try to schedule an appointment so we can help you through that process. If you're planning to borrow after July 1st of 2026, so there are some people out there that either haven't started this process or maybe you've already been borrowing for your child but they're not done with school. Here's where you're going to need to be strategic. If you do take any new loans on or after 2026, you'll be locked into the standard plan for all of your Parent Plus debt. So you might consider, and I know it's like we never thought we'd see the day when we would be recommending private loans, but you might consider using private loans to fund the rest of the child's education. And I'll just give you an example. Let's say you've been funding your child's education for 3 years, but they've got one more year to go. So you need another year's worth of loans, but you've already accumulated, $100,000 in Parent Plus loans up until this point, and you yourself are pursuing public service loan forgiveness. In order to continue to pursue PSLF on the $100,000 of loans that you have, if you take the additional the 1 year's worth of loans outside of the federal student loan system as a private loan, you can preserve access to the debt that you already have accumulated to these forgiveness programs. So not ideal, but it's at least something to think about. And again, we can sort of help you through some of these strategies. So I'm going to stop there, Carolina, and see if there are questions that we need to address.
I think people are just really looking forward to getting to this topic, the main topic, the Mary Bar. Yeah.
Okay.
Yep. Thank you.
Okay. So it is tax season, so we thought that um we would talk a little bit about what to do if you're a married borrower at this point. So for married borrowers, one of the most critical decisions that you may have to make in terms of your federal student loans is what your tax filing status is going to be. So choosing the right tax filing status makes a difference um, in terms of your federal loans, although it has no bearing on your private student loans. So if you have only private student loans, this really doesn't apply to you. There are quantitative and qualitative considerations that go into this choice, so we're going to review both of those. Um, and if you do sign up for a counseling session on this topic, we recommend that both spouses attend, because even if only one of you has federal student loan debt, the filing status that's chosen is going to affect you both. So just to make it more efficient, it's best if both people are going to be there. Our role is not going to be to make a tax filing status recommendation for you. It's going to be to provide you with enough information so that you make a fully informed decision. So these are the 4 steps. I'm not going to go over each one right here. You can, print this out when you get this and put it on your wall if you're going to follow the process. But let's go step by step, starting with step 1. So the first thing that you need to do is to determine whether or not an IDR plan, one of those income-driven repayment plans, is right for at least one of you. So to do this, you want to think about what your strategy for eliminating your debt is. If your strategy is to pay the debt off in full, sometimes traditional plans, those standard plans, may be a better option. This strategy is generally going to be for people whose income is high in comparison to their debt. They can afford to make more than the required payments or lump sum payments. And if you're just trying to pay the debt off, you want to pay as quickly as possible to save on interest. Now, the second bullet point here is probably where most of our clients lie, where you've got a relatively high debt and a low to moderate income, and your strategy is really going to be to pay the minimum while you're pursuing some forgiveness program, whether it's PSLF or IDR forgiveness. So an income-driven repayment plan is generally going to be required for this type of strategy, which means that tax filing status is going to be an important choice. The final strategy is, and tends to be for older borrowers, pay the cheapest plan until you die. And I know that sounds a little bit depressing, but there's a reason that we mention this. So if you're an older borrower and maybe you've got late in life loans for yourself, or you have a bunch of Parent Plus debt, but you're close to or in retirement, PSLF may not be an option. You may be faced with paying a loan for 20 to 25 or even 30 years, which if you're 50, 60, 70 years old, could mean that you have to pay for the rest of your life. The reason that we mention this is that federal student debt is dischargeable in death, unlike other types of discharged consumer debt where the estate has to deal with the debt once the primary borrower is deceased. That doesn't happen in the federal student loan system. So if you're in this camp, you just want to pick the cheapest plan, make that payment until you pass, knowing that is going to accrue to that it's not going to affect your family members. And the types of repayment plans that can work for this strategy could be an IDR plan, could also be a traditional repayment plan. But the bottom line is if at least one spouse wants to pay in the IDR plan, the tax filing status becomes an important factor. If neither spouse is using an IDR plan, stop here. You don't really need to hear the rest of this. Okay, so step two, you've already determined that at least one person is going to need an IDR plan. So you want to calculate the payments for both spouses, if both of you have federal student debt, filing taxes jointly versus filing taxes separately. For all current income-driven repayment plans, so that's for IBR, Payee, and ICR, and for the new WRAP plan that's going to become available in July of this year, if you file your taxes jointly, the payment is going to be based on the combined income of both parties. Whatever the combined income is on your tax return, that's what the payment's going to be based on. If you're filing your taxes separately, the payment is going to be based on the applicant's income alone. I'm going to go over, I'm going to have examples of all of this so it may make it a little bit clearer. For IBR, Payee, and ICR, when you file your taxes separately, the spouse is counted in the family size. So that's actually an older regulation that they tried to change as part of the SAVE regulations, but because all the SAVE regulations are getting scrapped, this regulation, which tends to benefit borrowers, is in the books for now. For Payee, IBR, and ICR, applicants can include children in the family size for the purposes of calculating student loan payments if they provide more than half support for them, even if those children don't live in their household. You can also, by the way, for these plans, claim any other person that happens to be living in your household that you provide more than half support for. When you're filing separately, the dependents claimed for student loan calculations do not have to match what is reported on your tax returns. So that's for IBR, Payee, and ICR. For WRAP, they don't necessarily calculate a family size. What they do is they're going to give you a $50 reduction in the payment for each dependent that's claimed on your tax return. So if you're filing separately, if the child is claimed on the spouse's return, the IDR applicant is not going to get that reduction in their own payment. In most cases, the payments in an income-driven repayment plan are going to be based on the tax filing status from the last filed tax return, as long as that tax return was filed in the last 2 tax years. If you plan to change your tax filing status, the payments can only be adjusted after a return with the new status is filed. So if, for instance, right now, the last time you filed taxes was in 2024 and you filed jointly, but you're planning to file separately in 2025, you wouldn't get the benefit of filing separately until you filed an IDR application that's based on your 2025 taxes once they're actually filed. Okay. And then there's the adjustment factor. And this is something that's very unique for married borrowers in the federal student loan system. And this applies to people who file taxes jointly where both spouses have an outstanding federal student loan debt. What happens in those instances is that one payment is calculated based on your combined income, and then it's allocated to the IDR applicant based on whatever their percentage of the total debt is between the two spouses. So let me give you an example. We're going to be working with Margaret and Ilan, who have a combined federal student loan debt of $130,000. Margaret, who's going to be the IDR applicant for this particular example, has $78,000 worth of debt. That's 60% of the total. So she's going to be responsible for 60% of the total payment that's going to be calculated based on their combined income. Elon, who is the spouse, has $52,000. So his debt accounts for 40% of that 130,000. So he's going to be responsible for 40% of the total payment calculated. If he chooses to pay in an IDR plan, he does not have to necessarily. When applying for IBR or payee, the spouse is not required to choose the same repayment plan as the applicant. So basically, um, Margaret can get that adjustment and enroll in an IDR plan. Elon does not have to choose the same IDR plan from Margaret to get that adjustment to her payment. However, if you want to benefit from the adjustment and you're looking at the ICR plan, then both parties need to enroll in ICR. And we have been able to confirm that the adjustment is going to be available for borrowers in the WRAP plan, and it will be applied the same way as it's applied in IBR or payee, where the spouse can choose a different repayment plan, and the IDR applicant still gets the adjustment. So let's look at some numbers and just try to figure out how this all pans out. So Margaret and Elon are married and they have one child. In this first scenario, only Margaret has federal student debt. So Margaret earns $50,000 annually. Elon earns $75,000. Combined, they have $125,000. The best option for Margaret is going to be the IBR plan for new borrowers. If they file jointly, Margaret's going to pay $709 a month because remember, the payment is going to be based on the combined income, and there's no adjustment because Elon does not have any federal student loan debt. So she bears the full brunt of the combined income. If they file separately, however, Margaret's payment is going to go down to $84. So it's a huge difference. And as a couple, they're going to save $625 a month or $7,500 per year if they file their taxes separately. So generally speaking, if only one spouse has federal student loan debt, but they both have income, it's going to be a lot cheaper to file for the student loan payment if you file your taxes separately. Now let's take the second scenario. In this scenario, both spouses have federal student loan debt. So Margaret and Elon, both, they're still married. They have one kid, same debt levels. So Margaret, remember, has 60% of the total debt. Elon has 40% of the total debt. Margaret earned same earnings capacity here. If they file jointly as a couple, they're going to pay a total of $709. Remember, they're going to calculate one payment that's based on the combined income. But Margaret's going to pay 60% of that. That's 425. Elon will pay 284. But together, they're going to pay $709. If they file separately as a couple, they're going to pay a total of $529. So Margaret's going to pay 84, but Elon's going to pay 445. So they're still going to save money if they file their taxes separately, but not as much money as if when only one person had federal student loans. They're only going to save $180 per month or a little over $2,100 for the year. And I just threw in here some tools because this can be a little bit complicated to figure out. You can always reach out to us to help you. If you want to figure out the married borrower adjustments, you're going to need to do it through the Federal Student Aid Loan Simulator. On the EDCAP website, we don't have the married borrower adjustment just yet, but we do have calculations for the WRAP plan if you're interested in that. All right, so let's see now. We calculated all the numbers. We've calculated the numbers separately versus jointly, and we know what the impact is going to be on student loans. So here's the second step to this process. As probably a lot of you know, if you're married, generally speaking, if you're married, when you file jointly, there is a tax benefit. And if you file separately, you may wind up owing a little bit more in taxes. So what we're going to do in this next step is once you have all the student loan information, you're going to need to consult an accountant or a tax professional and compare the savings in the student loan payment to the impact that filing in that favorable status will have on your taxes. So for the purposes of this exercise, I've just determined that filing taxes separately is going to cost the couple $3,500 more in taxes. And I didn't come up with that by doing any kind of accounting work. That's just a number that I established to help illustrate how this process works. So in scenario one, and remember, scenario one was where only Margaret had federal student loans, the couple is going to save $4,000 overall if they file their taxes separately. So that is they're saving $7,500 on student loan payments, but it's going to cost them $3,500 more in taxes. Net net, they're going to save $4,000 if they file their taxes separately because the savings on the student loan payments are so high. In the second scenario, however, you compare the savings for the student loan savings, which is only $2,160 if they file their taxes separately. The amount that they'll have to pay in the extra amount that they'll have to pay in taxes exceeds what they would save if they file their taxes separately on their student loan payments. So in that case, in that instance, they will actually save as a couple $1,340 if they continue to file their taxes jointly because the tax savings is higher than the student loan savings. And then the final decision, we're almost there. I mentioned earlier that there are quantitative and qualitative steps that go or things that go into making the final decision. Um, Usually the cost is the overriding and dominating decision, but there can be some other factors that you might want to take into consideration. So, are you a couple that counts on a big tax refund once a year? If you do, and you're going to get a bigger tax refund from filing taxes jointly, you may decide that you just want to continue to file jointly. How do you manage your finances? Do you look at these finances separately, or do you really look at expenses as the responsibility of the household? Sometimes borrowers look at these student loans, if they're married, they look at the student loans as the obligation of only the person that holds the debt. And so that's the overriding factor. Ultimately, that's going to be your decision as the consumer. But whatever tax filing status that you choose, if you go through these steps, you will have all the information that you need to make a fully informed decision. A few other things that you should know for in terms of tax filing status and the impact on your student loans is for IBR, payee, and ICR. Unborn children can be claimed as dependents when you're applying for an IDR plan. So if you or your remember that these IDR plans have to be recertified annually. If you or your spouse become pregnant in between IDR recertification dates, you can have the payments recalculated to reflect the unborn child. Married borrowers, when you submit the IDR applications, you may be required to provide information about your spouse when applying for an income-driven repayment plan, particularly if you're filing jointly. That means that you must provide the name, the date of birth, the social security number. But just know there's no obligation on the part of your spouse to pay back your loans. And I don't know if you remember in the past, they used to actually make the spouse co-sign the loans. They've done away with that, thank God. So this is just a matter of putting some information in there. Basically, it's just to verify that what you're telling them about your tax filing situation is true. If you're married but separated, or if as an applicant you say that you cannot reasonably access your spouse's financial information, payments in an IDR plan can be based on the income of the applicant alone, even if you last filed your taxes jointly, but you would have to meet those specific criteria. Just as a reminder, forgiveness programs in the federal system are available to married borrowers just as they are to the unmarried borrowers, but the loan holder must meet all the eligibility requirements. So if you're the holder of a Parent Plus loan, but your spouse has a PSLF job and you don't, that doesn't mean that you're entitled to PSLF. You must meet all the criteria. And then I mentioned a little bit earlier that federal student loans are dischargeable in death. And so that means that if the primary borrowers die, the debt doesn't become an obligation of the estate or the spouse or the beneficiaries. And under the most recent budget bill, they have also declared that federal student loan debt discharged in death is not going to be taxable. So basically, once it's gone, it's gone. And that's generally not the case with other types of consumer debt, including private student loans. So I'm going to stop there, Carolina, and see if there are questions. I want to make sure we get to questions before we end the hour. If we have time, we'll just go over a few things about delinquency and default.
The only question that came up was around payee, and the question was, is there a scenario that you get the same amount under payee? I'm assuming you're eligible for it if you file jointly or separately.
Mm, there could be, and this would also apply for IBR. There is a payment cap that applies to payee and IBR. It applies a little bit differently in the two plans, but basically in either IBR or payee, you would never have to pay more than the standard 10-year fixed repayment plan. So let's say the payment cap was $500 and the income required to get that cap was going to be $150,000. Okay. If your income, whether your income alone or your combined income exceeds $150,000, that payment is not going to change. It's going to be $500. So that would be one instance where you could file your taxes jointly, and still get the same payment that you would have gotten if you file your taxes separately. But that's why it's kind of good to go through the exercise to make sure that that is in fact the case.
But Nancy, can I clarify that? Not because oh, this is great. Now more people have questions. But if you are subject to the payment cap and you're eligible for payee, that also means that you're eligible for IBR at 10%. And if both payee
Not
and
not not
IBR,
necessarily. Not necessarily. Remember, payee you may not be eligible for IBR at 10%. There are people that can be eligible for payee, but not IBR at 10% because of the disbursement rules. Remember, payee allows you to
yeah, yeah,
enroll.
yeah.
Yeah.
So,
Okay.
okay. So, but if you are looking at the plans and your amount under payee and IBR is the same, we would recommend that you take IBR because
Yeah.
payee is going to sunset in 2028.
Yeah. That
Yes.
agreed.
If me and my spouse both have consolidated Parent Plus loans, do we both have to apply for ICR for that adjustment floor you mentioned?
Yes. Yes. Although, if you're done borrowing and your loans are all consolidated, you only have to make one payment in ICR at this point. And then
And the
you can enroll in IBR, in which case you can do different. One person can take the adjustment and the other person can go into a different account, a different plan.
Great. So a follow-up question to that, which is a similar line, is the person is currently in ICR. Can they now, and they file jointly, can they now switch to IBR?
And I assume these are uh, Parent Plus loans, consolidated. I assume that's
Is
what.
that advisable? Currently in ICR. So they didn't say, so
Okay.
if I don't want to call out the person, but if you want to provide an explanation on that question, but do you want to answer whether it's Parent Plus or not?
So let's
So
so
yes, it's Parent Plus.
it's Parent Plus. Okay. Um, you should be able to. So Parent Plus loans, even when consolidated, didn't used to be eligible for IBR, but under the new rules, they are as long as they've enrolled in ICR and made one payment. So now it doesn't happen, the switch doesn't happen automatically. You would have to file an application to switch your plan to IBR, but it should be possible. And I believe that we've had a couple of clients that have been able to make that transition.
And I will flag one thing about ICR that, when you're running the IDR application on studentaid.gov, and that's something that honestly I'm recommending my clients to do, to run it. You don't have to submit it just to know your options. You want to pay close attention to obviously ICR if you're in ICR with the ability to switch over to IBR. For some very limited borrowers, ICR may be cheaper if their loan balance is lower than their income per se. So please do pay close attention when you're making the switch. But as Nancy mentioned, if you are a Parent Plus loan borrower in the past, you wouldn't be able to get into IBR. Now, as long as you make at least one payment in ICR, you should be able to switch. If you end up switching, pay close attention to any correspondence from your servicer, and we would be interested in hearing any challenges that you have, not related to Parent Plus, but in general, we've had some clients that get denied, probably more because of another issue known as the partial financial hardship. But let us know because the rule is that you should be able to switch over to IBR if you have Parent Plus loans as long as you make one ICR payment. Okay, next question. I am correctly in repayment under the, give me one second. Someone who has a very high payment and they're wondering how to lower it. So I'm gonna put our contact information in the chat. I would recommend that you schedule an appointment. And I'm also gonna flag. I know the beginning of the presentation focused a lot on Parent Plus, but this is why we focus a lot on Parent Plus. If you still have direct Parent Plus loans, be aware that you may need to consolidate them to maintain access to forgiveness and maintain access to um, payments based on income. I am again going to put in the chat our contact information, and I am also going to put some other link about Parent Plus. Okay. Give me a second. Nancy, do you
Well,
want to continue with the questions?
yeah, while you're doing that, let me so I see somebody said please explain the disbursement rules around IBR and payee. So that's actually a really good question. So each of those plans has qualifications that depend on when your loans were dispersed. So to be eligible for payee at all, you cannot have had any loans dispersed before October 1st of 2007, any FELP or direct loans dispersed before October 1st of 2007, and you must have at least one direct loan dispersed on or after October 1st of 2011. So that's the disbursement rule for payee. For IBR, there are two different versions of IBR. Um, if your first loans were dispersed on or after July 1st of 2014, but before July 1st of 2026, you're eligible for the newer version of IBR. That's the cheaper version with the shorter path to forgiveness. But if you have any loans that were dispersed prior to July 1st of 2014, you're only eligible for the older version of IBR. And that's why some people can be eligible for payee, but not eligible for the newer version of IBR because they had loans dispersed prior to July 1st of 2014. Okay.
Okay.
Um,
Nancy, I'm just going to interrupt you. I did put the information in the chat. I do have to jump off to another meeting, so I'm sure you can answer the rest of the questions. I'm sorry, y'all. Thank you.
okay. Thanks, Carolina. Okay. So I think we answered that one. I'm correctly in repayment under parent student loan. However, I believe my monthly payment is excessive. Okay, I think this is the one that Carolina said you should reach out to us and try to schedule a one-on-one meeting. Um, Parent Plus loan consolidated in 2015. I'm not really sure what the question is there, but if you already have a consolidated Parent Plus loan, and you've been making payments in the ICR plan, you should be able to switch to IBR. I am currently paying the Parent Plus loan that my mother took out for me, all while simultaneously paying for my federal student loan and private loan through Sallie Mae. Is there a way that I can enroll in the IDR plan for my mother to make smaller payments? So this is an important question. Your mother is responsible for the Parent Plus loans legally. Like you have no legal responsibility for those loans, and you can't, other than just maybe helping her with the process, you can't use your financial income to lower your mom's payment. She may be eligible for a lower payment in or in the IBR plan, or in the ICR plan, but it would have to be based on her income, not yours. So this is a little bit of a complicated, and we've seen people in this situation. You might want to reach out to us to see if there's anything that we can do to help your mom lower the payment, but it cannot be based on your income. Okay. How are borrowers eligible for payee IDR forgiveness? Yeah. In if 20 years is metric. Well, that's a really good question, to be honest with you. That a lot of us are scratching our heads as to how that's supposedly going to happen. Um, it might have something to do with qualifying payment credit that people got from the IDR account adjustment. But honestly, I have asked the same question and I've yet to get like an actual answer. But the department is saying that they've identified, I think, about 800 people in payee that are going to be eligible for forgiveness. So I wish I knew the answer to that question, and maybe someday we'll get clarification, but right now I don't have that. Okay. I think, have I answered every question here? Okay. Currently, in ICR, income is higher now that we filed jointly. Can we change to IBR now? Again, I'm not 100%. So if you're in ICR, if you even whether you're a Parent Plus borrower or not a Parent Plus borrower, if you're in ICR, and IBR is a better option for you, you can switch to that plan. Just remember, whenever you file an IDR plan, whether it's and you're enrolling, recertifying, switching repayment plans, they're going to ask you to provide your most recent income as proof of income. So if that's higher than what it was the last time, or what then what the payment that you're currently making is based on, it may not be beneficial for you to do it right now. Again, this is something you might want to reach out for an individual consultation. Okay. Um, okay, so somebody's asking about contact information. We're not going to be providing individual contact information. We have program contact information. Although there are links to schedule meetings with both myself and Carolina. Unfortunately, unfortunately, we our schedules are pretty heavily booked, but we have a lot of other counselors, so we just encourage you to use the contact information. You can either book an appointment online, you can call the EDCAP helpline number, or you can email us. If you do want to speak directly to me, just call the EdCap helpline number or email the program number, and they'll pass the question on to me. And thank you, Bradley. It's nice to hear from you. Glad to see you're still around. Um, I am a consolidated Parent Plus borrower in ICR. Can I apply online to switch to IBR? Yes. So that is the online application should allow you at this point to switch from ICR as long as you've made one payment in ICR into the IBR plan. And I know I have filed applications for my clients to do this. I personally haven't had a client that's had the application process, but some of my colleagues have. So apparently it is working. It's just a matter of time. But again, to reiterate what Carolina said a little bit earlier, um, if you are if you get denials for any reason, we want to be made aware of that. So let us know, call us up, send us a copy of the notice that you got from the servicer, and we'll start working on challenging that, because the system should allow you to do it at this point. Okay. In the interest of time, I think we're a little bit over. I'm just going to say a couple of words about default and delinquency, even though that wasn't the focus of our presentation today. But it's important because there is sort of this explosion in people who are very delinquent or imminently going to be in default. So just so you know, in the federal student loan system, you're delinquent after you miss one payment. After 30 days, you're going to be assessed a late fee, but the delinquencies aren't going to be reported to the credit agencies unless you miss three monthly payments. So after 90 days, and at 270 days or 9 months, then you become at risk of default. So what happens when you go into default? The debt is payable immediately and in full. There's no access to income-driven repayment, forbearance, or deferment. You will get no credit towards forgiveness, and you have no access to federal student aid if you're looking to pursue your education. And of course, paying the debt immediately in full is a non-starter for the vast majority of people who are in default. Um, of course, the most potentially damaging thing is that you would eventually be subject to involuntary collections. And just remember, for federal student loans, the government does not have to take you to court. All these things that I'm going to mention, they can do administratively, meaning they just send you a notice and they do them. So they can garnish your wages up to 15% of your disposable pay, although they must leave you with at least right now $217 per week. They can intercept your tax refunds up to 100%. And they can offset 15% of Social Security, but they have to leave you with $750 a month, which of course is not a whole lot to live on. Um, Right now, involuntary collections are paused. The administration has been up and down on this matter. They've announced that they're going to collect, and then they suspend the collections, then they announce collections again, then they suspend them again. So most recently, they have suspended all collections, so administrative wage garnishments, tax refund intercepts, and Social Security offsets. They didn't say for how long it was going to be suspended, but based on the tone of the press release, most of us are guessing that it's not going to resume earlier than July of 2026 and could possibly remain in place longer. However, despite the fact that collections are paused, if you're in default, we are encouraging you to get out of default now. Collections could resume at any time. Last time they said that they were going to turn them on, they gave about a month's notice for administrative wage garnishment. So and it takes a little while sometimes to get yourself out of default. So it's best to start the process now so that you're not subject to these these types of involuntary collections going forward, and it doesn't become a shock. But just know that during this tax season right now, you should not be at risk of having your tax refunds intercepted. As long as you file by April 15th, that certainly isn't going to happen if you've got defaulted federal student debt. There is this Treasury offset program hotline that you can call to see if you're scheduled for collections. It only applies to tax refund intercepts and Treasury offsets. I'm not even sure, frankly, whether there's anything on that right now, but in the future, if you want to know whether you're scheduled for an offset, you can call that number. But it's not going to tell you about wage garnishment. You would have to wait for a notice for that. Okay, and that's it. As I said, the contact information is going to be on our on the deck when you get it, and everybody will get a copy of the recording and the deck. Reach out to us if you need help for a one-on-one. And thank you for everybody for participating. And we look forward to seeing you in the future. Bye bye.